China's management of the yuan is risk number one. Nick Stamenkovic, Ria Capital. Nick, while there are various items on the policy front, markets remain very much flow-driven, with data and surveys offering nothing more than an excuse for post-hoc rationalisations of markets' movements. Will there be any relief this week, do you think?
I think essentially we've seen a modicum stability in the risk markets for two reasons. One, the oil price has stabilised on the hopes that there might be a pleasing production between the OPEC and non-OPEC members. And two, the Chinese authorities are giving the impression that they don't want to devalue the currency, and they're actively intervening in the money markets to keep the currency relatively stable. But the underlying fundamental picture still remains unclear. The global economy still remains in a precarious position, and there's downside risk, particularly to China going forward. So I'm not convinced that the worst is behind us, but at least for now we seem to have a modicum of stability.
Now, Japanese Manufacturing PMI made for a very downbeat reading this morning. Analysts say discerning what was attributable to the yen surge and what may simply have been due to Lunar New Year timing effects is very difficult. But what is your take?
Well, certainly the yen has risen very strongly contrary to many people's expectations. It's seen as a safe haven currency in the time of uncertainty that we've seen recently. The yen has actually benefited, particularly as the markets pared back significantly expectations of US rate hikes for this year and for most of the next year. And the Japanese economy is very dependent or important. Exports are important, so clearly the weakness, the strength of the yen has had an adverse impact on that and has hit business confidence hard. And that's one of the key reasons why the Nikkei has performed so poorly this year.
Euro sterling and cable are in the red as we start the week. At the end of the week, we'll have the G20 meeting in China. The overarching narrative of the G20 is increasingly good during crisis, but less relevant over time. Can China revive the G20?
I think, as usual, the G20 is going to be a bit damp script. There are hopes we might see some coordinated action, but I think that's unlikely. There's little scope on the monetary front, coordinated point of view. And secondly, from a fiscal point of view, many countries still face highly indebted economies. So that there's no China itself is between a rock and a hard place. On the one hand, they don't want the economy to hit a hard landing, so they use fiscal and monetary policy as levers. On the other hand, they don't want to go back to the bad old days of just after the financial crisis, when they created a bubble in the housing market, particularly, and credit bubble in certain sectors, after very accommodating and aggressive fiscal and monetary policy easing moves. So I think overall, the G20 meeting is unlikely to provide much of a lift for risk assets near term.
And Nick, just lastly, can you tell us what else you'll be keeping an eye on this week?
Well, the data really this week is very much second order. We got Q4 GDP figures, both in the US and UK. I'm keeping an eye on the durable goods orders data because the business investment cycle in the US seems to be disappointing. And obviously any developments in China, although there isn't any major data there. Clearly the main focus at the moment seems to be very much in the UK. And if we see further opinion polls there showing what the gap between the ins and the outs is, that's clearly going to have an impact on the currency, which has already seen a sharp move against the dollar and less than the euro.
Nick, great to speak with you, thank you. Well, viewers, for a closer look at the pound's movements, click back for today's press review with Louise Macaulay. For me and for now though, it is goodbye.